Hi everyone. I wanted to try out my first live stream here today and do just a stock market question and answer session while I share with you my screen of my stock recommendation list here. These are the list of stocks and how I have them rated: buy, hold, sell, top stocks to buy, best stock to buy, etc., etc. Hi everyone. Thank you for joining. Feel free to ask questions. Hey Luca, hey William. All right. So first question is my view on ASML. So ASML was one of the big companies that reported earnings this week, along with Taiwan Semiconductor Manufacturing and Netflix. Uh, ASML's earnings were disappointing. The company basically told investors that revenue is going to be about 2.5 billion lower than they forecasted for 2025. And then at the same time, they also said expenses were going to be higher in 2025 than they initially expected. So the company telling investors revenue is going to be lower, costs are going to be higher, and so profitability is going to be lower in 2025. And that really caused the readjustment of ASML's stock price lower. I think it's down almost 20% since it announced earnings. Still, I did a video reviewing the company's results, and even after the big recalibration, I felt the long term risk versus reward is still worthwhile for ASML stock investors. All right, so let me see what the next question I can take here. All right, Andre Robinson asking about my take on Netflix earnings. Uh, if you didn't already see, I posted a video on my Netflix earnings review, and I thought Netflix's earnings results were excellent. I mean, I really had to nitpick at a few things that were not excellent in the company's earnings results. Revenue was better than expected, subscriber growth was better than expected. The company's forecasting operating profit margins higher than they initially thought for this fiscal year, and the ad supported tier and the password sharing crackdown, those two features are really driving incremental growth in that business. Netflix has demonstrated that they're really good at what they do, and they're the best in the business in the streaming segment. They've been able to withstand all of the new competition that came in and still deliver best in class performance. I really like that business. I've had Netflix rated as one of my top stocks to buy, I think, for 2 years now. Last year, I believe it was on my list as well. And it's certainly been on my list all year in 2024. And I reiterated that rating following the company's earnings results yesterday after the markets closed. Okay, let me see for the next question. All right, Long Trang, one of my members, thank you for joining as a member, Long. Asking what my thoughts are for the market and whether it'll keep making new highs every week. Man, the market's performed really well in 2024 across the board, whether you look at the S&P 500 or the Nasdaq. Wherever you look, it seems like the market's performed well in 2024, and it's been justified, in my opinion. The economy has performed broadly. The macro economy, at least in the United States, has performed much better than expected coming into 2024. Remember, there was probabilities of a recession. Some were forecasting like a 30 to 40% chance of a recession in 2024, because remember, in 2023 there was all those interest rate increases to fight inflation, and there was concerns that those were not going to work, that inflation was going to persist at a higher level. And so there was concern that the Fed needed to keep interest rates much higher for much longer to really contract economic activity so that inflation would come down. But it turns out they are not going to need to do that, as we saw a couple of weeks ago when the Fed lowered interest rates by 50 basis points, nonetheless, not even 25 basis points, indicating that inflation is coming down and they don't need to have interest rates at that higher level. And then earlier this week, we got data on unemployment claims being lower than expected and consumer spending higher than expected. And so the economy has performed well, and that's justified the increases in the stock market because companies are generating better earnings per share, better cash flow, and so that leads to more profitability, and so investors are willing to pay higher prices for companies with higher profitability. And that looks like it'll persist for a while, at least in terms of the profit and cash flow figures. There's so much investment going into artificial intelligence and the build out of these AI data centers, and there's increasing spending and it's adding productivity. Companies are able to do more with the same amount of employees or to do the same amount of work with fewer employees. So it's really fueling profit and productivity growth in businesses. Now, will the stock market keep going up like this every single week? Probably not. This has been a pretty remarkable run here so far in 2024. But in terms of the fundamentals of the economy, it looks really good. Unemployment is extremely low, inflation is coming down. There's a lot of investment in businesses uh, creating this onshoring trend where the United States is trying to continue bringing back more jobs here in the US. So that's really supporting growth here, at least in the United States, and driving economic growth. Let's see, what's the next question I want to take? I'm seeing a lot of questions about NEO, and I don't know if I want to address electric vehicle companies, especially NEO in particular. My views on electric vehicle stocks, I think over the last couple of years have been clear. It's a very difficult business to be in. The industry, I don't like the industry, electric vehicles overall. Now, the electric vehicle industry in China is much better than anywhere else in the world. In the United States, the electric vehicle industry, I think many companies got a little confused with the demand around 2021, 2020, and 2022 when there were supply chain shortages. So traditional car companies were not able to produce as many vehicles as they usually produce. And so I remember, around 2021, I called the dealership or asking about an SUV I was interested in buying, and they quoted me at $10,000 above MSRP. Now, if you've bought a car before in the US, at least, that's not usual. You don't get you don't pay above MSRP when you're buying a car. Usually, you get like a discount, 5 or 6,000 off the price, depending on, if it's a 30 or 40 or $50,000 car. But during 2021 and 2022, that's what was happening because there was such a shortage. Well, when there's a shortage of those legacy vehicles, electric vehicles got a boost in demand because consumers looked and said, well, there isn't anything else. We can buy these, they're available. So let's go ahead and buy it. We need a car. And so there's a miscalculation about demand, and that created this oversupply industry wide. And now we're seeing the consequences of that, especially in the US, where there's so much supply of electric vehicles and demand is now coming back down to reality now that there's legacy vehicles in more production. And the car business overall is very capital intensive. It requires significant capital expenditures to build out those manufacturing facilities. And then you got to continue spending significant sums of money on research and development every year. And then on top of that, every single car sale comes with a significant incremental cost, because when you sell a car, you have to make a car to sell that car. I was talking about Netflix earlier. When Netflix gets a new subscriber, it doesn't need to make new content for that each new incremental subscriber. It already paid money for the content. And so each incremental subscriber that comes on is just profitability on the bottom line that's building. The car business is not like that. Every new customer needs a new car built for that individual customer. And so that's why you look around, you look at margins, profit margins for car companies, they're very low. And it's not just one or two car companies. You can look around the world. Car company profit margins at scale are pretty low. For me, it's an unattractive industry. I would not want to be in any name in that industry. All right. I see Paul asking about RCL, which I think is Royal Caribbean Cruise Lines. I have not evaluated Royal Caribbean RCL stock in a while, but I remember when I was looking at cruise stocks a while back, I noticed one big positive going on with cruise stocks coming out of the pandemic, and that is an opportunity to increase earnings per share by paying down debt. I remember Carnival Cruise, their debt balance went from 10 billion up to 30 billion dollars, and that was at much higher interest rates because when Carnival borrowed that money, they were borrowing that money out of desperation during the time when their business was essentially locked down, so they had to pay higher interest rates to borrow that money during the pandemic. And now that their business is booming coming out of the pandemic, they're generating significant cash flow, and they can use their cash flow to pay down some of that debt, which was up to $30 billion dollars at one point from 10 billion. So an incremental $20 billion dollars in debt at much higher interest rates. So now that the cash flow is booming again industry wide, those cruise companies, RCL included, can use the cash flow to pay down the debt, which will then increase the earnings per share because when you pay down debt, you have lower interest expense. And then they can use that incremental extra cash flow to again pay down more debt and then increase earnings per share. And they can have that positive virtuous cycle going on for several years until they get those debt balances back down to where they were pre-pandemic. And so, so long as the business continues generating robust demand, which it is, um, consumers are spending a lot more money away from home still, um, getting out of the house, spending money on travel and experiences, restaurants, travel, more so than they're spending on things. And I think there's a little bit more to go in that. But I don't think it's going to come back down drastically. I think it's going to reach a peak and then stay elevated for some time. All right. I got a question on SoFi stock. SoFi, I've had rated as a buy all year long. I recently updated that recommendation. I did a price target video for SoFi stock, and I think I found that the intrinsic value for SoFi stock was around $21 per share. Correct me if I'm wrong. I did that video about 2 weeks ago. I suggest go back and watch that video. I talk about what I think the value is for SoFi and SoFi stock. And overall, just I like that business model. Brick and mortar banking, I think, is not very effective. And so having an online bank is much more effective use of resources. And the traditional banks are not utilizing their brick and mortar locations. If you go in there, many of these banks, at least in my neighborhood, they have like 8 offices for people to be there to help the customers that come in. And I rarely ever see an individual there. So there, why have those brick and mortar locations if you're not staffing them and training your staff to really help your customers? And so that brick and mortar model, I think, is outdated, and SoFi has an opportunity here to capture customers through more effective banking online. All right, I got a request to scroll down my list here. There you go. All right, so similar to SoFi, I got a question about Upstart stock. Upstart is a little different than SoFi. Upstart uses artificial intelligence to make lending decisions. And the big thing about Upstart is that it hasn't gone through a recession yet. And so lenders don't really know how that model is going to work. And when you're operating a business like that, you don't really know if those lending models are going to work better than the legacy models or worse until you go through a recession. Because during a recession is when people really start defaulting on those personal loans. When the economy is going good, as it has been, in the United States, right? Unemployment has been around 4% for a while now. So you're not going to get defaults on loans when unemployment is this low. And so we'll find out when we go through a recession if Upstart truly has the better model for making loans. And if it does, then that business is valued, should be valued much higher than it is today. Now, in the short term, it is benefiting. As you notice, they announced a $2 billion agreement with the partner to make to sell some of their personal loans or to have the partner be on the platform. And that's really helpful for Upstart because they don't want to use their own capital to make loans. The whole thought of the business model was to be a marketplace to bring together borrowers and lenders on the platform, and for Upstart to just kind of take a hands-off approach, just provide the model for decision making. And because the lenders pulled back, they had to step in and make some of those loans themselves, which is not ideal. But temporarily, they had to do that. Now that they made that deal with the $2 billion, SoFi announced a similar deal you probably saw. That will help facilitate more lending on the platform in the near term. Longer term, the big question is that company has to go through a recession, unfortunately, to prove itself. It's not looking for a recession, but it needs to go through one in order to prove if their lending model is more effective than the traditional lending model. All right, Christina is asking about Fiverr and Snap. They've gone down so much. Do I think they'll come back up? And what are their chances of going back to previous all-time highs? Good question, Christina. Fiverr and Snap have been two of my more disappointing recommendations here in 2024. I really like their business model. Fiverr, again, just for those of you that don't know Fiverr's business model, it brings together those that want to buy services and those that want to sell services. And it just makes a profit off of each transaction on the platform. And if you've been following my channel, you know I'm a fan of that kind of business model. It's been proven to be very lucrative. Many other businesses have operated that business model where they're just the platform. They bring together two sides of an equation and they take the profit from the transactions on the platform. Now, Fiverr's been held back several concerns, one of them being artificial intelligence is going to hurt the business because people are going to look to artificial intelligence to solve some of those problems that they were going to Fiverr for. And I think those concerns are overdone. And Fiverr's management team has addressed some of that, how, AI is helping drive growth for the business. It's not causing a decrease in the business. So I still think Fiverr is undervalued and I still like the business longer term. I don't know when it will recover. I don't know what the catalyst will be for Fiverr to recover, but I like the business model and the fundamentals look strong and the valuation is really cheap. So I still like that. And then the second part of your question, Snap, again, that social media business model, very attractive. It's proven to be very profitable. You can look at meta platforms at a larger scale. It's just such a lucrative business model. Folks like you and me are creating the content on these social media channels for free, basically, and they get to benefit from the engagement on the platform and generate advertising revenue on the platform. The total addressable market for advertising this year, there'll probably be roughly $1 trillion spent on advertising. So it's an attractive market opportunity in terms of the revenue generating capability. And on the cost side, you can generate significant amounts of content for very, very low costs because your users are creating that content. So I like that business model, and Snap, I feel, is undervalued. All right, Murat is asking about Taiwan Semiconductor. I believe I published the video this morning on Taiwan Semiconductor stock. I reviewed the company's latest financial quarterly results, which were strong, and I reiterated my recommendation for Taiwan Semi stock following their quarterly earnings results. All right, Paul is asking about Palantir. Palantir has been on fire this year. I had Palantir stock rated as a buy to start the year. And then I believe I told investors to take profits in Palantir stock. I don't remember off the top of my mind exactly when, maybe 1 month ago. Correct me if I'm wrong if you've been following more closely. Because the valuation got so stretched, I think it was trading at a forward price to earnings of around 80 the last time I checked up on Palantir stock, which was maybe a week ago. Um, I think an attractive place to get into Palantir stock is at a forward price to earnings of around 45 is a really attractive place to get into Palantir stock. But we've gotten very little opportunity to get into Palantir at that valuation. Um, to start the year was there, and I recommended it as a buy because the valuation was around 40, 45. But from, I've been following Palantir for several years now, and it seems like every time it touches that level, 40, 45 PE, it just pops back up so fast that you don't really get an opportunity to get in there because it just jumps back up so quickly. So if you can, if there's an opportunity to get back in at 40, 45, great. Otherwise, I feel the valuation is stretched at current levels, even though the business is doing great. It's best in class. Cash flows are improving. Profitability is improving. They're making inroads in businesses, which is where I really wanted to see them make progress because we know they're great with governments, right? The governments can afford Palantir. They're best in class. They're very expensive. Governments, governments, they don't really care about costs, and so they just go out and they spend money. It's not their money they're spending, so they just go out and spend it. But what I was really impressed with Palantir is that they're making progress with enterprises. They're I think it's AIP program where they go in and they do the boot camps, they demonstrate the value they bring, and their commercial business, especially in the US, is accelerating. That's been really exciting to see. And so there's a reason why the stock price is up so much is because the business is making such good progress in that regard. Seeing a lot of questions about Novo Nordisk. That's not a company I follow, so I can't really comment on that. Thank you for buying the book, David. I got a question about AMD. AMD AMD's got two things going on. On the one side, their AI data center business is doing really well. Their new chips are doing reasonably well. Management said it's the best product they've launched in a very long time, so that's doing well. Um, then the other side of the business not recovering as well as they thought. The PC business is not doing as well. And then about a week ago, we got some news that third quarter sales of personal computers were actually down year over year. I was expecting an increase year over year in personal computer sales. That's not what's happening. So that's been a little disappointing. And AMD gets a significant share of its revenue and profit from the PC industry still. A much smaller Nvidia has a much smaller percentage of its business coming from personal computers and the GPUs that go into PCs for gaming, whereas AMD has the GPUs that go into the PC for gaming, but also the CPUs that go into the PCs, the central processing. And so that's not going as well as they expected. I do expect that to rebound, not here in the third quarter that they're going to report on, maybe in the fourth quarter of 2024, but surely in 2025. And the reason I say that is because several tailwinds are going to push PC sales. Number one, these AI PCs are going to drive more productivity, so people are going to want to upgrade. And then remember, in 2020 and 2021, people bought a lot of computers because they were working from home, learning from home, etc. Right? So those computers need to be upgraded. If you're working a computer that's 4 years old, that's going to be outdated. You're not going to get good productivity from a 4 or 5 year old computer for work. Now, if you're just using it for browsing the internet and emails, you can use a computer for 10 years. But for work, those are going to be outdated and slower, and you're going to want to upgrade those. And so that's going to drive one of the bigger replacement cycles in the PC industry. And then that part of AMD's business should recover to supplement some booming demand from artificial intelligence, which AMD doesn't need to take a big share in the AI market to really drive shareholder value. If they can just get like 10% of the AI optimized data center business, I think that'll be great for shareholders. Right now, they're not near that. So they expect to get there, but they're not there yet. I see a question on Microsoft, and Microsoft I've had rated as a buy all year in 2024 and also in 2023 and probably 2022 as well. I can't remember that far back. Um, I, Microsoft is one of the better businesses in the world, operating profit margins north of 40%, cash flow from operations to sales north of 40%, uh, decades and decades of proven innovation capability. in creating new products that drive incremental consumer demand, revenues in the hundreds of billions of dollars, strong competitive advantages, difficult for any business to encroach on Microsoft. So really like that business. The stock is not cheap. I think it's at a forward PE around 30. So it's a good value here. It's a good business. Selling at a reasonably uh, fair price. I wouldn't say it's cheap, but I think it's a fair price. All right, I'll do maybe one more question here before I end this session. So this was my first live stream, everyone, and I kind of wanted to do this and see how everything works and see your interest in this. But I wanted to do this more for earnings releases, and my goal is to do one for to do a live stream for Nvidia's earnings release upcoming, so we can follow live as NVIDIA releases its earnings, and I can go through it step by step and take questions while I'm evaluating. And then you all can get to see, when that fresh earnings report comes out, how I go through it step by step, the things I look for, how I evaluate the latest earnings release and incorporate it into my existing analysis for a company, because most companies that I've been following for several years. So the latest piece of information goes into a existing information set that I've already built up for so long. And thank you everyone for joining. Let me see one last question. All right, so let's take this question, which is more of uh, I guess it's a more of an educational topic here. I think last week I taught my students at university the difference between the market price and valuation, right? And this is a question from Phoenix, who asked, "What price is a good entry point for Palantir?" Right? So I'm going to take this opportunity to do that. Explain a little bit the difference between market price and valuation. And there's a big difference. A stock price can be much higher than it was last year or 2 years ago or 5 years ago, but it can be cheaper than it was 5 years ago. And when I say that to students, I get all these confused looks on their faces like, what do you mean, professor? How can you tell me that the price just went up by $100, but it's cheaper than it was before the price went up by $100? And the big difference there is, if the price goes up by $100, but you're getting more than $100 in value, then the valuation is cheaper because you're getting more in return. It's like if you go to a supermarket and you're buying a 12-ounce can of soda for $1, but they stop offering that 12-ounce can of soda for $1, but instead you're getting a 24 pack for $5. And I tell you it's cheaper, but you tell me it's $5. How can it be cheaper than $1? And the difference is what you're getting in return. You're getting 24 cans of soda instead of one. And so it's cheaper when you consider it on a per ounce basis. You're paying more, but you're getting better value because you're getting more per ounce. And it's similar with business. When you're looking at Palantir, the market price might be higher, but the valuation is also higher because the earnings have not gone up as much as the price has gone up. And so, to answer your question, what price is a good entry point for Palantir? I wouldn't focus on the market price. I would focus on the price to earnings or price to free cash flow. And I think I highlighted earlier in the live stream that for Palantir, I was targeting a forward 1 year price to earnings of around 45, 47 as an excellent entry point if you can get it at that price. I don't know if it'll ever go down there to get it at that price, but if you can get it at that price, it's a great entry point for Palantir stock. All right, with that, I wanted to end this live stream. Thank you everyone for joining. I will be doing more of these. My goal is to do one for Nvidia when they announce earnings, and I'll send an announcement and I'll send a post and I'll let you know in my other videos and comments that I'll be doing a live stream and when it'll be. This one, I just wanted to get it out of the way, do my first Q&A live stream. Thank you everyone for joining. Thank you everyone for your comments. Thank you everyone for subscribing and watching my content. I really, really appreciate it. Thank you so much, and I'll see you all soon.